What is representativeness bias? Imagine you see a person dressed in a business suit and assume they are a lawyer, or you hear about a new stock that looks like a big winner and immediately buy it. These quick judgments are examples of a mental shortcut called representativeness bias. It's a common way our brains try to simplify decision-making by matching new information to familiar patterns or stereotypes. Instead of analyzing all the facts, we relying on what seems typical or similar to past experiences. In personal finance and investing, this bias can lead to mistakes. For example, an investor might think a stock is a good buy just because it looks like other successful stocks they have seen before. They might ignore important details like the company's financial health or market conditions. This can cause them to underestimate risks or overlook warning signs. People also tend to overreact to recent trends. If a certain sector or fund has performed well recently, they might believe it will keep doing so. They see a short-term pattern and assume it reflects the overall market or future results. This can be dangerous because markets are often unpredictable and influenced by many factors. When it comes to risk tolerance, representativeness bias can cause investors to take on more risk than they should. They might think because a certain investment has performed well in the past, it will always do well. But past performance isn't a guarantee of future results. This bias can push investors into making overly optimistic decisions, which might lead to bigger losses. Banks and credit unions need to understand this bias because it influences how clients make investment choices. They can help by explaining the importance of diversifying investments and using statistical data instead of relying on stereotypes or recent trends. Educating clients about the risks of judging investments based on superficial similarities can lead to better long-term decisions. In short, representativeness bias makes us see familiar patterns where there might be none. It simplifies choices but can also lead to errors. Recognizing this bias helps investors and financial advisors avoid jumping to conclusions and encourages more careful, balanced decision-making. This way, portfolios stay more stable and aligned with true risk levels.